I think ultimately because what you've seen is an increase in unemployment. And generally, as unemployment then comes down, as we see the vaccines rolled out, that tends to drive earnings and equity markets higher. You've seen a huge amount of savings being pent up, about $1.4 trillion in the US of savings that wouldn't normally have taken place. I think that as the vaccines get rolled out, that's going to be deployed. And the other thing is that as profits pick up, that tends to lead to a pickup in business investment. And all of that, I think, is going to stoke earnings and equities over the next year.
It's a very, very short-term phenomena because we're only starting to see this now. But what's been notable as we've seen the Democratic numbers come in on this Senate race in Georgia is the 10-year yield is back through 1%. And we're seeing Eurozone yields respond in the same way. And the gilt yield also higher here in the UK. If we begin to see a steady rise in yields, does that not shift the maths when it comes to equity market values? And does that not imply that we might actually be nudging against the ceiling on how much more upside we can see?
I think what it does is it favors value stocks where steeper yield curves benefit, for example, the financials, over some of the growth stocks which have benefited from the decline in interest rates. And indeed, I think that's what you're seeing at the moment. You look at futures this morning on the back of this news from the US election, the assumption that the Senate is going to now be controlled by the Democrats. As the curve has steepened, you're seeing NASDAQ underperforming a bit. Now, that's probably partly also to do with fears that there could be higher taxes, which would affect the foreign revenues of some of those large tech names more than some of the other companies in the index. But certainly that yield curve steepening, I think, would be beneficial for some of those financial and value stocks.
Mike, if I can just do a bridge from that to the traditional portfolio, I know you're talking about the 60-40 construct of a portfolio also not holding the same amount of merit, but we've seen a lot of investors go into gold, some of the other asset classes as well. If you do start to see those inflation rates tick up, where does it leave some of the other alternative investments that investors have been picking up in the last few months?
Yeah, so I think that if you look at alternatives in whole, what we're thinking about really is that given that we're now going to probably see more fiscal stimulus, it makes holding a large amount over government bonds not that attractive, given that we could see further upward pressure on yields there. So I think that certain types of income investor are going to be looking to alternatives, such as infrastructure, for example, which have played a very stable role in providing reliable cash flows during this recession that we've seen, and offer a much more attractive yield than you're seeing on things like treasuries or government bonds around the world. So for income investors, I think you're going to see continued demand for infrastructure. But in terms of diversification, investors, I think, are increasingly going to have to look to hedge fund type styles. And what we've seen is that strategies like some equity long short, equity market neutral, and indeed macro strategies have done a pretty good job of protecting during the sell-off that we saw back earlier in 2020. But can probably deliver better returns over the next few years than you're likely to see for treasuries. So I think a combination of things like infrastructure, but also things like macro strategies are going to play an increasingly important role as people start to shift away from treasuries and government bonds.